Okay, welcome back to Return on Life. Today I have with me again Sebastian Carrick. He is a regional sales manager at Equitable Life of Canada. And today's topic, we're going to talk about why someone would get a children's policy. Sebastian, welcome back again.
Thanks for having me, Peter. Good to see
All
you.
right. So here's the question of the day. Why would someone get a life insurance policy on a child?
Well, yeah, it's a great question because it's almost like a taboo subject when people talk about life insurance on a child. But what it does for that child, and it, the way it can set them up is like you can't even measure it. Sometimes I've seen instances where you've created such a multi generational asset, and I guess that's the thing I would say is you're giving them flexibility, really, when you purchase an insurance for a child.
And so, yeah, multi-generational. So this is like when we're doing something like this, we're think the thought process is not immediate benefit, although there are immediate, you know, if something were to happen, then it does provide, for the family. But you start thinking long term, like you said, it becomes a generate. Imagine the power of thinking generationally. It's definitely a mindset.
Yeah, it is, and there's a legend in our business called his name is Ron Barbaro, and he said it best. I think is buying insurance, a man's policy or a woman's policy at a child's rate, and I think that's the real essence. Is you're purchasing a permanent product for a child, locking in the rates at this age when they were just born or they're a couple of years old. You're locking in those rates for the life of the policy, and how that policy grows is of immense value. So I love his comment there.
And so important to that is how you use it to ensure that it is the power of that asset can last literally a lifetime, and then be able to use it for various uses. The parents can use it for things like education.
Yeah.
The person, when they become old enough, you could pass this on, right, to the child. And does that cause any implications tax wise?
Yeah, well, that's the powerful thing about our industry is you can create this asset, you can fund this asset, and you can transfer it. And in the Income Tax Act, there's a non-taxable consequence currently. Like I don't know if ever that will change, but as it stands right now, you could fund that asset, pass it on to that child into their hands, and there's no tax consequence.
And so while you're living, it's you can do that tax free. But obviously, sorry, what I was going to say, I was going to extend upon that last point of where I was talking about,
Mhm.
using it for education, not stopping the growth of the policy. You can, if you use it in a tax efficient way, you can collateralize it or borrow from it in order to use it for whatever purposes you need to, right?
Yeah.
Education, buy a car, down payment on a house, but never stop the growth of that asset, right?
And that's the power behind it. Like I don't think like there might be some advisors on the line watching this, but they know this stuff. But for the general public, here's as Peter said, here's an asset that you build, you pay for it. Let's say 20 years, you pay for it, and you could have that child use that for the next 60 years after you funded it and it's paid up. So there's so many different ways. A grandparent can start it and can set it up. And I've seen situations like this where the grandparent says, you know what, there's a certain thing that I want. I want my grandson or my granddaughter to go on a trip every year, compliments of me. I may not be around to see it all, but I want to keep this gift for them. And so the grandparent will fund a policy, transfer that child, and now that child could use it for the rest of their life. And you said it best is university is one stop. The second stop is maybe it's for a wedding. Maybe it's to start their first side hustle. Maybe it's to buy their first home or retirement. Like there's so many options. And Peter, I love the fact that you've articulated this is that you don't stop the growth of that asset, right?
And that's where part of why I think of that term return on life, right? Because it's really it's why we're even having these discussions on a week to week basis is really understanding some of the power of this tool, this product, outside of what the traditional people are have thought, maybe in the general public, what their preconceptions are of it. But here's different ways that you can use it. Now, if you're getting on a child, how young can a child be when you start a policy on
Great question. So I know some companies, I can't speak for all companies, but
them?
some companies it's 15 days old, some companies it's 30 days. So really, once that child is born, pretty much you can start this policy for them, and take them for, you could do it in a 20 pay, you could do it using an annuity. There's an approach that many advisors with equitable anyhow is buying an annuity, have the annuity fund the policy so it's paid up, and it's carefree. It's all done for them. So
Right. I think to expand upon that part is that um, maybe just making sure that you're working with the right advisor, you have the right plan in place, and know how to use it in a way to be able to ensure that it lasts a lifetime, or and then becomes truly a generational asset. Um, they can use it while they're living, and then the proceeds of that can go on to the next generation as well.
yeah, like how many investments, sort of, I didn't call it an investment. Um, think about how many investments that you can start that can impact four generations. The one that starts it to generation one, transfer it to the second generation, and then subsequently it can be transferred to the third generation, and then the fourth generation benefits from it. And along the way, generation two and three still have access to that asset. Like I can't think of any investment that you can utilize in the way that you can with an insurance policy.
Right. And just so we're clear on it, the type of insurance that you can get, is it term, whole life, UL? What's the
Yeah,
where
it's
does
permanent insurance, and in permanent, you have two branches. So you could have a universal life product for a child, or a whole life, or optionally a participating whole life. Now, in my experience, what I've seen is the majority advisors prefer a participating whole life insurance plan for the child, just because of the long term trajectory of growth in those plans.
yeah, and there's such a historical across pretty much any par whole life contract you see across all the carriers in Canada. All the ones I work with have been around for 100 years. The companies themselves, right? And
Yeah.
when you get that participating whole life policy, you're putting, it's a unilateral contract, and you're putting your responsibility is to pay the contract, but then the rest is up to the insurance company to grow that money, because they're gonna have to pay out that death benefit at some point.
Yeah, and I like that you bring in unilateral contract. Like, think about that for a minute. A client goes, puts forth all the information on application. The insurance company makes a determination, and once they've put that offer, it's unilaterally a unilateral contract at that point. Once the client signs it, so the insurance company can never do anything to that contract as long as the client pays their premiums. That's all they need to do. Like that is unbelievable, really, if you think about it.
And that goes back to your point of the costs don't change, right? You
That's
put
right.
in whatever it is, $5,000, $10,000 a year into a policy, it doesn't change for literally 100 years.
Exactly. And we're very fortunate in Canada. We've got great companies, like amazing insurance out there that have been around for 100 years or more. Their dividend payments, if we're talking about participating whole life, has been, maybe a year where one insurer might not have paid a dividend, but the track record is very strong for paying dividends through all the things that can happen in life. Like, think about 100 years. You've got wars, you've got famines, like you've got the Spanish flu epidemic, recently here, COVID, and still dividends are being paid.
And
So
multiple, I don't know how many, how you, how you count this, but,
Paul,
also how many recessions have been out there in the last
that's
100
right.
years, right?
The Great
Um,
Depression.
yeah. And so, I always think of it as, it's a part of someone's, life plan, right?
Yeah.
Would never say, yeah, deploy all your cash into this, but it's something that, can provide a really great complement to whatever anyone's doing in their life financially to help them really. When I say return on life, it's not about necessarily the financial things. It's like, well, maybe finances become less of a concern because you have this thing building for you, right? And you can use it for whatever life's purposes are.
Yeah, and you know what? If you think about it, this is not an investment that's going to knock the lights out. It is strong, steady, consistent tax advantage growth. So that's what that I really love about it. You know, that consistency.
Yeah, no, absolutely. Yeah, I mean, and so maybe we expand upon this to a bit. So we've talked about why someone would get, a policy on a child. Where does it? Let's talk about yourself, where you are at Equitable as a mutual life company. How does that maybe expand upon that point? How we connect the two of those?
Yeah, a great point here, and so again, we have great companies in Canada. We're very fortunate. Equitable stands out in being one of the largest mutuals. So, really, what that means is when you buy an insurance product for that child technically is the owner of Equitable Life, and having that focus that you've got a company that is vested in looking at clients because the clients own the company and making those long-term decisions that benefits the holders of these products is where we stand out, and you're going to see a lot more on that. What does mutuality mean, and what impact we can play as a mutual company in Canada to really impact and bring value. So you're going to see a lot more on that side, and I think the advisors like you do a lot of business with us, and one of the things that we find is advisors like to have an offering that's separate. And as you know, you can organize as a publicly traded company. You can organize as a fraternal benefit society, and the third one is a mutual. And so that's where we stand. And the mutuality really just means is we're not owned by shareholders. Those who purchase a participating whole life with Equitable own the company.
Right. And not that this will happen, but what happens if, at any point in time, a mutual life company becomes a publicly traded company?
Yeah, so all the publicly traded companies were at one time mutuals. So yeah, there is that possibility that that could happen. Right now, we don't see that happening on the horizon for quite a number of years. The focus is bringing what mutuality brings, what a mutual company brings into marketplace, that differentiator, and really expanding on that. But if that were to happen, 50 years from now, what would happen is the clients would own shares. So the participating holders of the company would own shares in this new publicly traded company.
Well, that's good to know. And I think, as you said, it has happened in the other, some of the other shareholder based companies in Canada as well. And I think going back to the power of this whole thing is you put $1 into a child policy. If you use it in the, you leverage all the tax advantage opportunities there are of storing your money in this contract, you may never see an ounce of tax on that dollar for the lifetime of the contract.
Yeah, absolutely. Just the way it's structured, and how the dividends are paid into the policy. So there is definitely a non-taxable element to it, depending on what you do with the plan. But again, that flexible, even if you use the flexible means of saying, okay, I'm going to fund my education with this, you can do it without affecting tax. I'm gonna, use it for starting my own company. You could do it without affecting tax. Even retirement, you could do it without affecting tax. So this is why it's so important. And I know you have a lot of, uh, folks in the general public that are watching this YouTube, sorry, not YouTube, this podcast, Peter, and for them is it's important to get the right advice, right advisor. Do your due diligence, because it's important the advice that you're getting. And we, are fortunate again. We have really really good advice in Canada. The advisors that I've come across, solid, just like yourself, Peter. But it's important that you do have the right advisor helping you with your decisions.
Yeah, I agree. The right advisor with the right team as well. I
That's
wouldn't
right.
make any decisions or provide recommendations without involving my extended team, whether that's CPA or lawyer, and then the client side as well. That they have those conversations are happening on both sides to make sure that it definitely connects with your plan and your vision, your goal. To your point, generationally, right? So powerful.
Yeah, and I'll give you kudos on that. Is one aspect that I really like about the way you run your practice is you're bringing in teams, because you don't want to wear all the hats. You want to bring in experts. So I think that's a valuable look at when you're looking for advice. You want that cohesive team that brings their expertise to the table to help you, because again, life is not linear. It's up and down, and sometimes you need to make the right decisions for yourself. So it's important to have that valuable advice. So kudos for the way you run your practice.
Yeah, thank you. And yeah, here's to looking to a bigger future than our past, right?
Yeah.
So yeah, so Sebastian, I appreciate you coming on again this week. We'll be back with another topic. I think it's Easter Monday next week, but maybe we could do that, or we can do another day. Go from there. But thank you again.
Perfect. Thanks, Peter.
Thank you.